The Peter Schiff Show.
Today's podcast is sponsored by ExpressVPN. ExpressVPN is an app that routes your internet connection through their secure servers so your ISP can't see the sites you visit. Go to expressvpn.com/gold and get an extra 3 months free. Today's podcast is also sponsored by Kalshi. Kalshi is the first legal financial exchange in the U.S. where you can bet on any event. Bet on things like, when will the Fed cut rates? Or will TikTok be banned? Or will there be a forced sale? Go to kalshi.com/gold and the first 500 traders will get a $20 credit. All right, well, another week has gone by and another all-time record high in the price of gold. In fact, silver went along for the ride, setting a new 4-year high intra-week. Price of silver got above $42.50. I think I saw gold trading above 2,685 yesterday. We did have a bit of a pullback today. Gold dropped about $16. We closed the week at 2,659, but that is the highest weekly close in the history of gold. Silver also down on the day, back below 32, closed at 31.60, but it was still up. I mean, gold was up about 1% on the week. Silver was up about 2.5%. Not a bad week. Unless you are invested in the mining stocks, they were actually down on the week, a week where gold hits a new all-time record high and closes at a closing weekly high. You had the GDX down 0.4%, the GDXJ down 0.3%, though both indexes intra-week did hit new 52-week highs. They managed to close down because both these indexes were down 3% today. And why? Well, gold was down $20, or not quite, and they got killed. This is the same old, same old. This is exactly what has been happening to these gold mining stocks the whole rally. Gold has dragged the miners kicking and screaming. Normally, in a bull market, the stocks lead the metal. This time, it's the metal that's been dragging the stocks because nobody has conviction. Nobody believes this bull market. In fact, I'm watching on the networks, financial networks, and they're now starting to mention gold casually. And maybe I even saw on one show on Fast Money on CBC, the guys said, yeah, I think gold's a buy, silver's a buy, the miners are a buy. But they're trying to figure out why, and they have no idea. Everybody is trying to figure out why gold prices are going up. Yet they're ignoring the obvious reason because they don't understand it. So they'll say something like, well, inflation is coming down. The economy is in good shape. Everything is great. So why is the price of gold going up? They don't understand. The price of gold going up is throwing cold water all over that narrative that inflation is coming down. Inflation is not coming down. Why do they think it's coming down? Because the Fed says so? The Fed is lying. They're not being honest. In fact, look, we got data that came out today. The Fed's favorite measure of inflation, which is the PCE, the core PCE. Now, the reason it's the Fed's favorite is because it's the least accurate. It's the measure that understates inflation the most. That's why the Fed likes it the most. But that came out today. And the core PCE for the month of August was up 0.1, right, which was a little bit better than the 0.2 for the prior month. But year over year, which is the number they're looking at, core PCE was up 2.7%. That's one tick higher than the 2.6 from July. That is supposedly what the Fed wants to be at 2%. The core PCE year over year. They want that at 2. It's at 2.7. It's closer to 3 than 2, and it's moving in the wrong direction. So based on that, why is the Fed cutting interest rates when their favorite measure of inflation is not only not near 2%, it's actually heading further away from 2% as we speak? So gold is saying that the Fed made a mistake, that there is a lot of inflation. These guys on Fast Money, when they started to recommend the gold mining stocks, they were coming up with a theory on why these stocks would do well with disinflation or deflation. Those were the scenarios. They didn't think there was going to be inflation. And the reason they thought that this would help the mining stocks is they said, well, when there was inflation, the cost of mining was going up. And so now that we don't have inflation anymore, maybe mining costs won't go up, and that's going to be good for gold miners. So that's all they could think of. They didn't realize that gold was telegraphing higher inflation, although they did have a point in that costs have come down. That is the crazy part about gold stocks being down this week, because oil got clobbered this week. In fact, oil prices closed at $68.64. That's down on the week. It closed last week at $71. And if you look at the price of oil in gold, which is particularly important if you're a gold mining company because you're mining gold. So what everything costs relative to gold is extra important for you because gold is what you've got. It's what you're mining. Well, at one point, it got to exactly 40 to 1. 40 barrels of oil with just 1 ounce of gold. You've never been able to buy that much oil with that little gold, other than, that brief moment in time during COVID, which was a complete aberration when you had oil prices going negative, although you couldn't buy any actual oil negative. It was just in the futures market. But this is the cheapest oil has ever been for gold mining companies. This should be great news for their earnings because that's what their biggest costs other than labor costs. And, the dollar index, even though it was down on the week for the 4th consecutive week in a row, we had a falling dollar index, which is also bullish. The dollar index closed at 100.42. But in particular, the dollar was very weak today against the Swiss franc and the Japanese yen. We're barely hanging on to an 84 handle against the Swiss franc. And I think the fact that you're seeing this kind of weakness relative to the Swiss franc and the yen, right? These are the currencies that are perceived of as like the safe haven, right? When they talk about the cleanest dirty shirt in the hamper, they're really talking about the Swiss franc because the Swiss franc is a lot less dirty than the US dollar, but also the yen. People tend to buy yen when they're worried about stuff. And the fact that people were rushing into the yen today, rushing into the Swiss franc today, that shows me that there's a lot of nervousness out there about the dollar. And the dollar is not a safe haven when people who own them are selling them to buy Swiss francs or to buy Japanese yen or to buy gold. That's why gold is going up, and that's why the Swiss franc is going up. People are looking for safety, and they no longer consider the dollar to be safe. They no longer consider treasuries to be safe. Again, treasury yields did go down slightly on the week, but you could barely notice the change. And in fact, since the Fed cut rates, yields on 10-year and 30-year treasuries, they've gone up. And they're going to go up a lot more. That's why I know the Fed is going to go back to QE, because the Fed wants lower interest rates. That's why they cut rates. Why do they want lower interest rates? Because they know the economy is in trouble and they want to rescue it with lower rates. So they cut the Fed funds rate, but it didn't produce an effect on the long-term rates because they had already discounted those cuts before they happened. But now that they have happened, long-term rates are going to head higher, and that is going to confound the Fed. They want them lower. And the only way they're going to get them lower is to return to QE. Now, there are people, I mentioned this, I think, on an interview, when I said I thought when the yield on the 10-year Treasury is back above 4%, that's going to result in the Fed going back to QE. And they said, well, but they got to 5% and the Fed didn't do QE. That's true, because then the Fed wasn't as worried about the economy as it is right now. The Fed was still hiking. But now that they're cutting, it's because they're worried about the economy. And so therefore, they don't want interest rates to go up. They wanted interest rates to go up back then. They don't want that anymore. And so when interest rates go up, when they want them to go down, they will go back to quantitative easing. And that, again, is the real reason that gold's going up, because the gold market is looking forward to QE. And the people in the mainstream media who are looking at it still don't get it. They still trust the Federal Reserve. And that is also one of the main reasons we've been able to get away with all these deficits and the artificially low interest rates and the QE programs, because at the end of the day, the market still trusted the Fed. And they actually still do. People still have confidence. You can look now at the break evens on tips. If you don't know what these Treasury break evens are, this is a spread between what you get on a Treasury inflation protected bond and what you get on a regular Treasury. Now, you get a lower rate on the tip because you get the kicker of the added payment based on the CPI. So if you compare the yield that investors demand on a Treasury without inflation protection versus the yields that they get when they have that protection, you get what they call the break even, which is what inflation has to be before you break even on buying tips. And if you go back over the last few years, in January of 2021, the break even on the tips was 2.1. So that means that investors expected inflation to be 2.1, right? And so where you broke even on your tips, if inflation was 2.2, you made money. You had a better yield than if you bought regular treasuries. Well, inflation ended up being 4.7 in 2001, according to the CPI. So everybody that bought tips had a big windfall. But even though we had 4.7% in 2021, in January of 2022, the break-even rate was 2.24. So even though we had 4.7% inflation measured by the CPI in 2021, bond investors expected inflation to go down to 2.24 in 2022. It ended the year at 8%. That's how wrong the tip spread was. Then, even after blowing it for 2 years in a row, January of 2023, the break even was again 2.25, 2.24. So the market still believed, even though we had 2 years of much higher than 2% inflation, markets still believed inflation would be 2% or 2.24. It ended up being 4.1. Now, where is the break even right now? It's 2.15. So even though we have massive deficits that are exploding, and we have two presidential candidates promising to blow them up even bigger with more government spending or tax cuts, right? Nobody expects inflation to go up. Everybody still thinks the Fed can deliver on its 2% promise. Well, that's just a pipe dream. It's not even a pipe dream. It's pure BS. But I think that by next year, as inflation reaccelerates and the economy tanks and the Fed goes into QE, all of the Fed's credibility is going to be gone. And the markets are no longer going to expect 2% inflation. They are going to succumb to reality. And that is going to be a major financial disaster. Anyway, we got a quick commercial break. We'll be right back, so don't go anywhere.
Going online without ExpressVPN is like not closing the door when you use a public bathroom. Even if you think you've got nothing to hide, why give random creeps a chance to invade your privacy? Because all your traffic flows through their servers. Internet service providers, including mobile networks, know every single website you visit. And in the U.S., ISPs are legally allowed to sell that information to advertisers. ExpressVPN routes 100% of your traffic through secure encrypted servers, so your ISP can't see your browsing history. It's easy to use. Fire up the app, click one button to get protected. And it works on all your devices, phones, laptops, tablets, and more, so you can stay private on the go. ExpressVPN was actually the very first sponsor of the Peter Schiff Show, and I'm glad to have him back. I have it installed on all my devices, and I use it constantly because I can change my IP address to a different state and get access to the content online that isn't available in Puerto Rico, including any NFL game, because I can tap into the local coverage by setting my VPN for the city where the game I want to watch is being played. So protect your online privacy today by visiting expressvpn.com/gold. That's expressvpn.com/gold, and you can get an extra 3 months free. That's expressvpn.com/gold.
Now, one of the reasons or the catalysts for the gold rally during the week was the announcement midweek coming out of China that they were going to do another round of stimulus, right? Spend more money, get more money into the economy. And that not only caused gold to rally and silver to rally, but even bigger rallies in commodities in general, base metals, copper. A lot of these raw material companies really shot up on the news. The only commodity that went down was oil. I already mentioned that oil dropped. And the reason oil dropped is because on the same night that China announced this new stimulus, Saudi Arabia came out and said, we're going to increase production. They basically said, look, we're no longer really targeting $100 oil. We just want to grow our market share. And so we're going to ramp up production. And that sent oil prices down. If it wasn't for that announcement, oil would have been up quite a bit on the Chinese stimulus program. And I don't think that's a coincidence. My guess is that there was some behind the scenes arm twisting between the Biden-Harris administration and the kingdom there to increase production, to keep oil prices as low as possible before the election. The last thing that Harris wants is an oil spike, right? Because she's hanging her hat now on lower inflation. And now that the Fed has blessed that and said, hey, inflation's down, we can cut rates, Harris is claiming credit for bringing inflation down. In fact, they're saying, hey, look, it worked. We passed the Inflation Reduction Act. And what do you know? Inflation came down, right? As if those two were related. It probably would have come down more if they hadn't passed that act. But because of that act, when inflation turns back up, it's going to be a lot stronger because of the Inflation Reduction Act, which is really the Inflation Creation Act. But now that's what the message they're sending. We beat inflation. Even though they helped create the inflation, they're claiming credit for putting out the fire. The last thing they want is more sparks, right, to heat it up. And so I think they called in favors or whatever they did, and they got the Saudis to open up the spigots, at least between now and the election. But I think after the election and next year, we are going to see a huge increase in oil prices, especially since they're so cheap. As I said, oil right now is the lowest it's been in history, priced in gold. And that's the real way to price it. So we're getting a bargain on oil. Oil's not why prices are high. It's why they're not higher. But that's going to change, I think, next year. We're going to see a big move up in oil, and that's going to correspond with a big move down in the dollar that's coming up. And by the way, gold now is up, I think, around 28, 29% on the year. We're on pace, again, for the best year for gold since 1979. That's 45 years ago. I mean, so this is a very rare event to have gold this strong. This is not insignificant, and it's not like there's no connection between what the Fed is doing. They're cutting rates when they're already too low. The Fed has never started a rate-cutting cycle with the stock market at a record high, the real estate prices at record highs, the gold prices at a record high, supposedly low unemployment. The Fed has never done this. They normally wait for something bad to happen before they cut rates. Now they're cutting rates to prevent something bad from happening. They're so scared that the bad thing that's going to happen is going to be so awful, they can't even wait for it to happen. They have to act preemptively, right? They weren't willing to act preemptively to stop inflation, right? They wanted to make sure it was well above 2% before they did anything. But when it comes to helping the economy, they don't want to take any chances. They want to come in with the stimulus, in theory, before it's even needed. Of course, they realize how bad things are. That's why they're jumping the gun the way that they are. But gold going up like this is a significant warning. But again, when this happened in 1979, when gold was up, it was actually up over 100%. It was like 120, 130%. But in 1980, that's when Paul Volcker said, no mas, right? The buck stops here. Interest rates went to 20%. So after we had that big year in 1979, that was the end of the gold bull market because the Fed did what it needed to do. And we could afford it at the time. We could afford those really high real interest rates. I mean, we really had tight money when rates were at 20%. The Fed never got there, but Volcker got there. Well, what are we going to do next year? Is the Fed jacking up rates? No, they're cutting rates. And so this is not the end of the gold bull market like 1979. This is the beginning. This is like 1971. We are just getting started. Gold just broke out. And remember, gold is up now about tenfold since 2001 so far this century. It's up 10 times. I think it's going to go up another 10 times, but it's not going to take 20 years. It may do it in 10 years. And so where's gold going to be if it goes up 10x from here? Well, if it's 2,700 now, that's 27,000. Now, I know that sounds crazy, but believe me, 2,700 sounded crazy 20 years ago when it was 270. And in 1971 or 70, it was 35. And in 1932, it was 20, right? So look where gold is. But gold is going up. Now, the Fed's balance sheet is almost 10 times as big as it was before the 2008 financial crisis. Money supply is exploding. That's why the price of gold is going up. In fact, the price of gold is not going up. The value of our money is going down. And if it's already gone down this much in the past, imagine how much more it's going to go down in the future when we have much bigger deficits, when we're going to be printing even more money. The Fed's balance sheet is going to explode, right, over the next 4 years because it's already going. I mean, the deficits are already rising, and we haven't even officially started the recession. But the news out of China, that's what I started to talk about, is bullish. But I want to speak specifically, though, again, about stimulus, right? Because the Chinese are coming in and they're saying we need to stimulate the economy. And that is, all these governments, the U.S. government, Europe, Japan, everybody says that the government needs to stimulate the economy, right? When the economy is in trouble, we need the government to help it out with some kind of stimulus. And the stimulus usually involves cutting taxes or spending more money on something. But the economic reality is that governments can't stimulate an economy. There's nothing they can do. They can sedate an economy, they can screw an economy up, but they can't improve it. Now, one thing that they can do, but it doesn't really count, is they can stop harming an economy that they've harmed. So they can undo things that they have already done. That is the only thing they can do. I mean, think about somebody who's going to run a race, and on his back, there's this big backpack. And the government comes over and puts 50 pounds of weights in this guy's backpack and now says, now go run the race. Well, obviously, the guy's not going to run as fast with 50 pounds on his back, right? Now, let's say the government says, hey, let's stimulate this runner a little bit. And the government comes up and removes 20 pounds of weight. So now he's only got 30 pounds of weight. And now he's running faster. And now the government claims credit. You see, look what we did. We stimulated this guy by taking off 20 pounds. It's like, yeah, but who put the 20 pounds there in the first place? There's 50 pounds of government weight holding this guy back, right? So if there was never any weights on his back at all, the guy would have run a lot faster. But now the government wouldn't be able to stimulate him by taking some of the weights away. So all the government can do is they impose taxes, they impose regulations to slow down the economy. And then when they want to stimulate the economy, they undo some of that. Right? They take away some of the taxes. But when they say that, hey, we need tax cuts to stimulate the economy, that's an admission that the tax cuts are hurting the economy, right? Because if you can help the economy by lowering taxes, doesn't that mean you hurt the economy with the taxes? Of course, right? But they never want to do that. They don't want to accept responsibility for hurting the economy. They don't want responsibility for putting all these weights, right, in the runner's backpack, but they want to get all the credit when they take the weights off. But here's the problem. You don't stimulate an economy by cutting taxes if you don't cut spending. Because the real weight on the economy, right, is the spending. Those are the bricks that are in the backpack of the runner. It's not the taxes, it's the spending. That is the cost that the private sector has to bear. It's not how much the government taxes, but how much the government spends. Because what it's spending, it's taking from the private sector, and the private sector has to absorb it. one way or the other. The government can honestly borrow the money, but that crowds out private investment. If the government borrows the money, well, that's money a businessman can't borrow to invest in plant and equipment, right? So if the government borrows it, it crowds out somebody else, or it also drives up interest rates. Now, if they borrow from the Fed, well, then they just print the money. And so now we have inflation, right? And now the economy has to bear that burden because now prices go up. So there is no government stimulus. There's just a government sedative. Now, I guess the only thing that governments can actually do, there's one thing that governments can do that helps an economy, and that is establish a rule of law. Establish private property, courts, contracts, right? These are all the basics, though, because if I'm going to work my hardest, right, to go create something, to build a business, to improve a property, to invent something, I want to make sure that all my hard work, and I get to keep the fruits of my labor. If somebody can just steal, take whatever I've got, if I can't be secure in my private property, well, then I'm not going to accumulate the wealth in the first place. And we need that. We need individual entrepreneurs trying to get rich, because when they do that, they make everybody else better off. They produce the products, provide the services, invent the things that make everybody's life better. Nobody is going to do that if they think that whatever they earn is going to get taken from them, right? So the government comes in and provides this protection. So that is something the government can do to enable an economy to grow faster. But we already have that, right? So we established that hundreds of years ago in America. So the stimulus happened in 1789. That's it. Everything they've done since really has been a sedative. It's like if you're you go to school to become an economist, right? You can major, you get a PhD in economics. The beauty of capitalism is its simplicity. It just works all by itself, right? The best thing the government can do for the economy is get out of the way and just let the economy function. That is the greatest economic stimulus. It's free market capitalism. Do nothing, right? Let supply and demand set prices, and let the profit motive allocate resources. Just let that happen. The government just has to sit back and watch it. So here's the problem. Somebody goes to school and they invest a lot of money getting a PhD in economics. And what do they find out? That they have no value to add. There's nothing they can do, right? The best thing is to do nothing, right? I mean, how are you going to be an economist? What's your economic advice? Do nothing, right? So an economics degree is basically worthless because you can't do anything. Nothing that you can come up with is going to improve what already exists in a free market. So all you can do as an economist by coming up with a program is to screw something up. Like imagine if that was the case with medicine, right? What if you went to school to become a doctor and you invested all this money and now you're a doctor, but in medical school they teach you, the human body is a wonderful thing. It just heals itself. And every time it gets sick, it just gets better. And if we try to do anything, we're just going to screw up the natural healing process of the body. So there's really nothing that you could do as a doctor. Well, I mean, what are you going to do? You can't charge any money to do nothing. So somebody comes, a patient comes, you say, well, do nothing. Everything's going to get better. Well, what are you going to charge for that? Now, fortunately, that's not the case. The human body doesn't work like that. We get sick. We need medicine. There are things doctors can do to help us. There's nothing that economists can do to help us. When you become a doctor, right, you take the Hippocratic Oath. And the first part of that oath is to do no harm, right? That's the Hippocratic Oath. Well, imagine if they had a Hippocratic Oath for economists. Do no harm. They couldn't do anything, right? Everything they do is harmful. So if you understand economics and you got a degree, you do absolutely nothing and let the economy work. But that's not what the voters want to hear. The voters don't want to elect somebody that promises to do nothing. They want to elect somebody that promises to give them something for free. And so they're always coming up with a plan to stimulate the economy, and everything they do backfires. Anything they try to do to stimulate the economy sedates the economy. And there's going to be no difference in China, right? All this stuff is a mistake, but it may make the stock markets go up, right? We know that, right? Creating a lot of inflation is good for the stock market, but it's not good for the economy. Anyway, we got one more commercial break. We'll be right back.
There's finally a way to trade directly on events that directly relate to companies, such as what inflation will be, or interest rates, or will ChatGPT 5 be released this year, or how many cars Tesla will deliver this quarter. Kalshi, which was founded by two MIT engineers, is the first legal financial exchange in the U.S. where you can bet on any event. It's basically like the New York Stock Exchange or the NASDAQ, but instead of day trading stocks, you're betting on things that you actually care or maybe even know more about. The exchange has hundreds of thousands of users and has already seen more than $500 million of trading. Kalshi has a ton of company-related markets where you can make money by betting on the things that impact companies most. Let's say you believe the Fed will cut rates 5 times this year. It's currently priced at a 43% probability. You can buy shares of 5 rate cuts at 43% or 43 cents. The price changes based on what the market thinks the odds of that event are. Let's say you want to buy 100 shares and you pay 43 cents a share. Times 100, that's 43 bucks. If the Fed cuts rate 5 times, you win 100. If not, you lose it all. You can always sell your shares before the results come in. Like if the price goes to 80%, you may want to sell your shares for 80, booking a $37 profit rather than holding to the end and risking losing it all. You can also pick other numbers of rate cuts. For example, you can bet that 3 or more will happen this year. For me, I look at Kalshi as a fun way to gamble while potentially hedging some of your actual stock positions. Kalshi has many company-related markets to trade on. You can sign up using my link at kalshi.com/gold. And the first 500 traders will get a free $20 credit. That's kalshi.com, KALSHI.com/gold.
So just before the break, I was talking about the China stimulus and how it's not good for the economy, right? The government doesn't help the economy by spending money. And again, all stimulus boils down to one thing: inflation. That's all it is. That's all they can do is create inflation, right? They print money and they spend it. That is inflation. And that is always going to hurt the economy. It's never going to help, right? The government doesn't actually produce anything. All it does is get in the way of what other people would produce. And even if the government, builds something, right? They have to take the money from the private sector to build it. Well, what they're building something at the expense of something else that would have been built by the private sector that we wanted more, that would have had more value, that would have had more utility. You see, in a free market, capital is always allocated to its highest and best use, right? Whatever is going to create the most value for the most people, that's what's going to be built. But when government builds something, it's got nothing to do with creating value. It's about politics. It's about patronage and payback. And that's why they'll build a bridge to nowhere. That's a big victory, right? If some congressman wins a contract to build a bridge to nowhere in his district, well, that's a big win for that congressman, right? He creates all these jobs, right? People are working. Money is coming into his district. But we've wasted all of our resources. We built a bridge that goes nowhere, right? What good is that? That would never happen in the private sector. No one is going to build a bridge to nowhere in the private sector, because how are you going to make money on that bridge? Who's going to pay the toll to go nowhere? So that bridge won't get built. But the government doesn't give a damn. It's not their money. They don't have to make a profit. So the key to stimulating the economy is limiting government interference to as little as possible. So what would really stimulate the economy is a reduction in government. Now, again, that's because the government is the impediment to the economy right now. So when I say that the government can stimulate the economy by making itself smaller, it's because it's hurting the economy with its current size, right? It's like if I'm punching you in the face, I can make you feel better if I stop punching you, right? But I'm not really doing you any favors. I'm the one that punched you in the first place. So it's hard for me to take credit for the fact that I'm not punching you anymore and say, hey, look what I've done for you. I've taken away your pain. Yeah, you were causing my pain, right? So the government is the problem. Getting rid of the government is the solution. That's why it's unfortunate that in the Donald Trump campaign, that's not what we're hearing, right? Nobody wants to cut government. Everyone wants to cut taxes, but that's how you pay for government. How are we going to pay for it without taxes? Well, with inflation. Now, yes, at least Trump talks about tariffs, which are taxes and which will help pay for the government. He's being dishonest about who pays the tariffs. The Americans pay the tariffs, not the Chinese, not anybody else. It's a better way to collect taxes than the income tax. I agree with that. But what we really need to stimulate the economy is massive cuts in government. Now, Trump talks about it, at least, let's have an efficiency committee and make government more efficient. Well, the problem is government can't be efficient. It never will be efficient. That's the problem with government. You can't have efficiencies unless you have free market incentives, and they don't exist in government. So even though Elon Musk may be able to be efficient when he's running Tesla, he's not going to be efficient in the government. It's not the same dynamics. Now, yeah, he may be able to find a few things that you can cut, but you know what? Good luck getting them cut, because every dime that the government wastes, believe me, somebody is benefiting from that waste. Somebody is getting that money. And the minute there is a threat that they're going to lose that money, they are right at that congressman on the phone. You better not cut this spending, or we're going to give our money to your opponent and we're going to get rid of you in the next election, right? So there's a constituency behind every dollar of waste, fraud, and abuse, right? That's somebody's patronage. Somebody's getting that money, and so even if you identify it, you're not going to get rid of it unless you have a commitment to across the board spending cuts. They're not going to happen. And nobody wants to talk about that. So in any event, so that what they're doing in China isn't real economic stimulus, but it is a market stimulus. We know that. We know that when they start printing a bunch of money, what the prices that sometimes go up first are stock prices. That's why my emerging market fund was up 7% on the week. I mean, that's a big week for a broad-based fund. Now, one of the reasons the fund had a good week was because we're overweight China. And the reason we're overweight China in that fund is because Chinese stocks are actually very cheap. Right now, this stimulus may be the catalyst to get money to flow in, but the stocks are cheap. They need to go up anyway, with or without the stimulus. Now, maybe the stimulus is the catalyst to get the money to come in to stocks that were cheap anyway, because you get much better values in Chinese companies. These companies have good balance sheets, don't have a lot of debt, sitting on a lot of cash. And a lot of that cash, is Chinese currency, which is going up and is going to get a lot more valuable in the near future as the US dollar goes down. So I think, the emerging markets are really poised for some big gains, not because of the stimulus. The stimulus is just a catalyst to get the money flowing. But I think once the dollar really starts to go down and people start to flee overpriced US assets, they're going to look at these emerging markets because they've been very cheap for a long time and nobody's had any interest. And now all of a sudden, the markets are moving, regardless of the catalyst to get them moving. I think they've got some momentum, and I think this trade is going to have a lot of legs. And I've been talking about that I thought there was going to be a rotation from developed into emerging markets. There's been a rotation going on from growth to value, from speculative type stocks to dividend paying stocks. Well, now I think we're going to also see the rotation into the emerging markets. And so you can look at, my emerging market fund. If you go to the Euro Pacific website, europac.com, and you can look up all my mutual funds. I've been talking a lot about the gold fund, which, is a great buy. It was a great buy today because it ended up, again, all the week's gains eradicated in a single day because gold was down $16, right? Again, everybody is scared that gold is going to collapse. It's far more likely that it's going to take off. And as I've been saying on this podcast all year, the whole time gold's been going up from 2,000 to almost 2,700. I keep saying, get ready for a big Sunday night. We haven't really had it yet, but we're going to. I mean, I am convinced that the biggest move we're going to see in gold is going to happen when Americans are still asleep. It's going to get started in Asia. And so Americans are going to wake up to this crisis. And so what you want to do is go to bed protected. And that's why, you got all weekend to go to shiftgold.com and load up your shopping cart with gold and silver. And again, silver hit that 4-year high and then backed off. That's not the high. We're going higher. We're going to take out the high from 2020, which we haven't even taken out yet. That's around 34 and change. But once we take that out, silver could hit $50 this year. Gold could hit 3,000 this year. In fact, if it continues on its current trajectory, because remember, we're not even finished with the third quarter yet. We're almost there. But if you take the gains in the first three and extrapolate them into the fourth, we're pretty close to 3,000. That's a big number, even though I think we're going a hell of a lot higher than that. But it may be the type of number to wake people up. But while they're still sleeping, buy. So I would go to the Shift Gold site over the weekend. Today, Friday, Saturday, you could buy all weekend and buy some gold, buy some silver. And come Monday morning, if we haven't had a big move up in the gold stocks, then you'll maybe get a good deal on my gold fund. But regardless, right, I think we're going to have a big week. In fact, normally, again, the gold stocks, I said earlier, lead the metal. This time, they've lagged the metal, but they've been consistently wrong, right? If people have been looking at gold stocks as an indicator of where gold's going to go, and they say, oh, gold stocks are going down, that's signaling a drop in gold. They've been wrong. But you know what? Last Friday, if you thought that gold was going to go down this week and you shorted the gold mining stocks because you were convinced gold was going down, and so you wanted to short the gold mining stocks, if you covered on the close today, you actually made money on your trade, even though you were 100% wrong. Gold went up 1% and made an all-time record high, yet you still made money shorting the gold stocks. Now, the market is not going to be that forgiving for long. I mean, people are not going to make money being wrong on gold and shorting these gold mining stocks. I mean, there's going to be a point where they're going to go ballistic. I mean, we should have already got there. We're not there yet. It is going to happen. But again, I just look at the lack of conviction in this trade as more proof that we are so early in this bull market. That's the crazy thing. You could buy gold at almost 2,700 and you're a contrarian because people think, well, why buy it? And people still want to buy the tech stocks, and they still believe that everything is great. They still think we got a soft landing, that the Fed, performed, the miracle. They avoided recession. They put the inflation genie back in the bottle, right? It was a masterful, display of central banking. These guys are all a bunch of geniuses. Aren't we so lucky that we have the smartest people in the world that happen to be working on the Federal Open Market Committee? And through their excellent stewardship, they were able to bring back this inflation problem that came out of left field, right? and solve it. This is what the markets believe because, again, the TIPS rate, as I said, the break-even rate is 2.15. How can anybody think that that's the case? Now, the reason I believe that the markets are pricing the 30-year bond at such a low rate, it's not necessarily because they think inflation is going to be 2% for the next 30 years, because I think most of the people who own U.S. Treasuries don't expect to hold them for 30 years. And if it was an all or nothing trade, if it was like, well, if you buy it, you can't get out for 30 years, right? Nobody would get in. So I think people own the 30-year Treasury because they're going to trade it. And if they're buying it with a low yield, it's because they expect the yield to go even lower. Now, why would somebody expect the yield to go lower? Because the yield right now, right, on a 10-year Treasury is under 4%. Why would you expect that rate to go down? I mean, even if the Fed cuts rates, why should the yield go down? I mean, there's got to be a positive slope to a yield curve, right? I mean, even if the Fed lowers short-term rates to 2%, you would figure a 10-year Treasury should at least be 4%. There's got to be some extra return for taking 10 years of risk, because a lot of things can happen during that time period where you're exposed to inflation and interest rate risk. So there should be a positive slope. Nobody should be buying these bonds, especially now. Even if you believe the Fed, that the economy is great, there's nothing to worry about, there's no chance of recession, and we're lowering rates anyway, which is, inflationary, you'd be selling treasuries, but the yield should be higher. The reason they're not is because a lot of people in the markets believe, and they're correct in this belief, that QE is coming. They know that when the economy moves into recession, the Fed is going to restart QE. And when they restart QE, they know the Fed is going to be buying these long-term treasuries. And what happened when they did that before? Well, they went up. So traders are trying to front one the return to quantitative easing by buying the long end now. That's all they're doing. And if you didn't have that bet, if people weren't so convinced that another round of QE was coming, long-term interest rates would already be much higher than they are right now. That's the only reason that they're still this low. It doesn't mean, right, that investors are really this dumb that they think inflation is going to be 2% for the next 30 years. I mean, they may be dumb. There's no way they're that dumb. How can anybody think that with the enormity of the debt problem that we have, that they're going to be able to keep inflation at 2% for the next 30 years? Again, they're not thinking about the next 30 years. They're thinking about next year's QE program and selling their bonds at a profit because they probably levered up to buy them, right? Because they can make a lot of money on a small move when they're using leverage. So they're betting, people think that the Fed's going to go to QE, and they're right. But I think they're going to lose. They're betting right, but they're going to lose in the market. They're correct in that the Fed's going to go back to QE, but they're wrong in that that's going to produce a rise in bond prices like it did before, because now it's going to blow up. Because when they did QE before, the Fed was able to fool the markets into thinking it was temporary and that when it was over, they would normalize rates. And yes, the balance sheet is growing now, but don't worry, we're going to shrink it. Well, the balance sheet is still over 7 trillion. And when they go back to QE, they're going to ramp it up to 20 trillion. Good luck shrinking that. They couldn't shrink the 9 trillion all the way back down. I mean, didn't quite get to 9. It's not quite at 7, but it dwarfs. Remember, the balance sheet peaked at about 4.5 trillion after the 2008 financial crisis. And they did QE 1, 2, 3, Operation Twist, all that stuff. They got the balance sheet up to like 4.5 trillion. Then they started to shrink it. I don't think they ever got below 3 trillion. And the next thing you knew, it was almost 9 because of COVID. And now they've been shrinking it for years and it's still above 7. And the next time they ramp it up and it goes to 20, right? Where are they going to shrink it to? 18, right? So the market's going to realize this is debt monetization. This is banana republic. This is not a temporary thing. And again, when the Fed went to QE last time, they still were able to hide behind the BS 2% inflation target. They said, hey, look, yes, we're doing all this quantitative easing. We've got interest rates artificially low, but it's okay because inflation is under 2%. So even if our policy results in higher inflation, it's okay. It's actually an added benefit. We get 2 for the price of 1. We get to stimulate the economy and we get to get up to our 2% inflation target because we're below it now. So we actually need higher inflation and we need more economic growth. Oh, that's great, right? Because we can get all that by creating this the QE program. But now, when they try to do that this time, I've got a bug just flew in the studio and bit me or something. I don't know what that was. But anyway, what was I saying? The QE program, when they try to justify QE now, when inflation is already well above 2% and then rising, they can't claim that, well, this is good because it's also going to help us achieve our inflation goal because we're below 2%. If they're at 3 or 4% and they create inflation to stimulate the economy, then inflation goes higher, right? So now the Fed is exposed, right? The truth comes out. It's laid bare. And all the creditors know that this is permanent debt monetization, that there is no way out, that I was right from the beginning, that the Fed checked us into a monetary roach motel, right? Once you check into QE, you never check out, right? And that's what's happened, right? And when they go back to QE again, wait, what QE number is that going to be? I think it's QE5 or QE6. I lose track. We had 3 official QEs with numbers, but then they did QE. Some people call the QE affinity with COVID because it was huge. But let's say that was QE4. We're going to have QE5. I think they had 5 Rocky movies because I remember, when they first did QE and no one even thought they would do a second time. I knew they were going to do a second time. And I knew they would do a third time. And the reason I knew they would do it again is because it doesn't work, right? That's what the government does. The government never learns from its mistakes. Like they do something and they say, gee, that didn't work. Let's not do that again, right? Gee, that really screwed things up. That's not what government does. They do something, it makes the problem worse. They say, well, we just better do that bigger, right? They're never going to accept responsibility that, hey, we poured gasoline on a fire and the fire got bigger. Maybe we shouldn't put any more gasoline on the fire. What they're going to think is we threw gasoline on the fire got bigger. I guess we didn't throw enough gasoline on it. We need more, right? That's how these idiots in government think, right? Well, I knew what they were going to think before they thought it. And so I think that's what's going on in the bond market. That's what's going on in the gold market. But the mainstream media just doesn't get it. But the bond investors who are going out on the limb and who are buying long-term treasuries because they think the next QE program is going to bail them out and let them sell out at a profit to the U.S. government, they're wrong. They're going to be right on the QE, but they're going to be wrong because bonds are going to get killed because the inflation cat is going to be out of the bag and the dollar is going to be tanking. I mean, next year, I think, is going to be a disaster for the dollar. I think that once we crack through maybe 99.5, and we're almost there. I mean, we could easily crack 100 next week. We close below 90, 99.5. We could drop to 90, 89 by the end of the year, right? Another 10% down in the dollar. The dollar index is already down about 10% from its peak in 2022. And by the way, and I mentioned this before, the main reason, and maybe the only reason that we had headline inflation go from 9% to 3% is because the dollar rallied by 22%. That was it. The dollar rallied. Why did it rally? In anticipation of all the rate hikes. Anticipation of those rate hikes drove up the dollar. The high dollar brought down commodity prices, brought down oil prices, in addition to all the oil that we sold from the Strategic Petroleum Reserve. But that drop in commodity prices pulled down the CPI. Now that all those rate hikes are behind us and the rate cuts are in front of us, now we have the dollar going down. And it's going to go down even more in anticipation of more rate cuts. Apparently now I'm looking that there were 7 Rocky movies. Well, all right. Well, I guess we got more QEs to go to get to Rocky 7. Now that one must have been really, really bad. That's the other thing that we have in common with Rocky movies. Each successive movie gets worse than the one before. That's generally what happens with sequels. You make a good movie, it makes a lot of money, and so you make a sequel, and it's not as good. I mean, there's the exception. You got The Godfather Part 2. That was a good sequel, but rarely do the sequels come anywhere near the original. And the same thing with QE. Each time they do it, it gets worse and worse. But hold on, now, well, I just sidetracked and I forgot what I was talking about. Oh yeah, the dollar. And so the dollar, I think, is going to crack. Oh yeah, because it was the strong dollar that brought inflation down. It's the weak dollar that's going to bring inflation up, right? Because as the dollar goes down on foreign exchange, all our imports become a lot more expensive. And commodities, which are sold in dollars, become a lot more expensive. So it wasn't the rate hikes that brought inflation down. It was the effect those rate hikes had on the dollar. Well, now the rate cuts are having the opposite effect on the dollar. The dollar is falling, and so consumer prices are going to be rising. So I think we can crack 90, and that means 2025 is going to be a resurgent year for inflation. We could end up with a higher high than 9% on a year-over-year inflation rate, especially oil. Oil could be the huge gainer. I mean, I'm surprised that oil is as cheap as it is because, again, it's never been this cheap. So it's not going to stay this cheap, right? It's going to go up. It's going to bounce. And when the dollar goes down, it's really going to go up. And so we're going to have an explosion in inflation next year as the economy is in recession. And in fact, if the economy wasn't weak before inflation picked up, higher inflation will just weaken it more because it saps the consumer of their purchasing power. Everything now costs more money. And so they can't buy as much because everything costs more. And so the economy gets a lot weaker and everything kind of hits the fan. And so I think that's the year that we're going to kill it in the gold stocks, in the foreign stocks, in the emerging market stocks. I mean, it's going to be a tough year for America. I mean, I'm not happy about that. But I think it's going to be a good year for my investment strategy. And so, if I can't stop this bad thing from happening, it's better to make money from it than to lose money, right? Because it's going to happen regardless. That what I know is going to happen too, just like the government now, they want to vilify the grocers. Oh, and blame the grocery stores for rising food prices, right? You guys are greedy grocers. You're gouging your customers. That's why we have inflation. They're going to blame the speculators. When the dollar crashes and gold goes through the roof, they're going to say it's the foreign currency speculators that did this. It's the gold speculators that did this. We got to punish them. We got to cap them. We need windfalls profit taxes. We need exchange controls. All that's going to happen. But before it happens, I think we're going to make a whole hell of a lot of money. Anyway, on that note, have a great weekend, everybody. If you like this podcast, don't forget, give it the thumbs up, or on YouTube, like it, make a comment. And don't forget, my free newsletter. A lot of good stuff's been coming out. We had some really great letters that came out this week at shiftsovereign.com. If you're not getting them in your inbox, just make sure and go to Shift Sovereign. Just put your email address in there, and you're going to get our free newsletters. The news that's coming out, sometimes I learn some stuff I missed on the newsletters that are coming out. So make sure and sign up for that, and have a great weekend. I'll be back again next week. Bye for now.